When an investor sits down with a financial professional, before a single trade can ever be placed, something essential happens first. The firm must learn who this person is. That first step, the building of a customer account, is more than paperwork. It's where compliance, trust, and suitability begin. And on the Series 7 exam, it's where you start too. Every broker-dealer has to collect a minimum set of information when a new account is opened. The rules come from FINRA, and they're designed to ensure that firms truly know their customer. The account record must include the customer's name and address, their date of birth, taxpayer ID number, occupation and employer, and whether they're affiliated with another member firm. Those are the identifiers, the pieces that verify who's actually sitting across from you. But the record also has to capture more than demographics. It has to describe the customer's financial status, investment objectives, and risk tolerance. That's where suitability begins to take shape. When a new brokerage account is created, a representative completes what's called a new account form. A principal signs off before any trading takes place. Within 30 days, the firm must send the customer a copy for verification, and every 36 months it must be updated or re-verified. Those timeframes, 30 days to send, 36 months to update, are small but crucial to remember on the exam. Under the Patriot Act, each firm must also verify the identity of every new customer as part of its customer identification program. That means checking the person's name against the Treasury Department's OFAC list and keeping records for 5 years after the account closes. If someone refuses to provide identification, the firm simply cannot open the account. Once the basic data is gathered, the focus shifts to suitability. FINRA defines 3 levels of suitability. First, reasonable basis suitability, whether the product is appropriate for any investor at all. Second, customer-specific suitability, whether it's right for this individual, given their goals, time horizon, and risk tolerance. And third, quantitative suitability, whether the trading pattern in the account itself makes sense. Suitability always applies to recommendations, not just to executing orders. Picture a sample client. Linda is 52, an engineer earning $130,000 a year, married, mortgage nearly paid off, planning to retire at 65. She wants moderate growth with limited volatility. That phrase, moderate growth, limited volatility, defines her investment objective and risk tolerance. On the exam, that kind of phrasing often determines the right answer. If her broker suggested daily trading in leveraged ETFs, it would clearly be unsuitable because it violates that profile. Account ownership matters too. An individual account belongs to one person. A joint account can be set up in 2 ways: joint tenants with right of survivorship or tenants in common. In a survivorship account, if one owner dies, the survivor inherits everything. In tenants in common, each owner controls a portion, and if one dies, that share passes to their estate. If the exam mentions proportionate interest or estate inheritance, that's tenants in common. If it says automatic survivorship, that's joint tenants. Corporate accounts require documentation proving that the company's board has authorized the account and any trading authority. If the company wants to trade on margin or options, the resolution must say so explicitly. Partnerships must provide a partnership agreement naming who's authorized to trade. And for trust accounts, it all depends on the trust agreement. The trustee holds legal title and acts in the beneficiary's interest. The word fiduciary is your key signal. Trustees act as fiduciaries. A fiduciary, like a trustee, guardian, or executor, manages someone else's money. They cannot mix their own funds with client funds, and they must trade in line with the account's stated objectives. For minors, we use UGMA and UTMA accounts, the Uniform Gifts and Transfers to Minors Acts. One custodian, one minor. The assets legally belong to the child, and when that child reaches the age of majority, the account transfers directly to them. There's only one custodian and one beneficiary per account, though a custodian can manage several separate accounts for different minors. Trading authority is another piece. If a representative is allowed to choose the action, asset, or amount, that's discretionary authority. Any 2 of those 3 A's means discretion is being exercised. Before placing discretionary trades, the firm must have a written power of attorney from the customer. A limited power allows trading, but not withdrawals. A full power allows both. Every discretionary account is reviewed daily by a principal. Without written authorization, the rep cannot make those decisions. There's one small exception called time and price discretion. If the customer specifies the security, the action, and the amount, but leaves the timing or price up to the rep, that discretion only lasts for the day. After the close, it expires automatically. Some clients prefer privacy. A numbered account uses a code instead of a name, though the firm still keeps a record linking the number to the client's identity. The principal must know who that person is. Most brokerage accounts today also use street name registration. The firm holds the securities in its own name on behalf of clients. It simplifies record keeping and settlement. All customer information must be protected. Regulation SPP requires firms to send initial and annual privacy notices explaining how data is shared and giving customers the right to opt out of third-party information sharing. Customers get account statements at least quarterly, and if the account has trading activity, monthly. Trade confirmations go out no later than the day after the trade, T+1, and show the price, commission, and whether the firm acted as agent or principal. If a client travels or prefers digital access, the firm can hold mail, but only with written instructions specifying how long, generally up to 3 months. Firms can also deliver documents electronically if the client consents, and electronic delivery is treated the same as paper. For older clients, FINRA requires that new accounts include the option to name a trusted contact, someone the firm can reach if there's concern about financial exploitation. If a representative suspects exploitation, the firm can place a temporary hold on disbursements while it investigates. This applies to any specified adult, meaning anyone 65 or older or someone over 18 with a cognitive impairment. When a client transfers an account from one firm to another, the process uses the ACAT system, the Automated Customer Account Transfer Service. The new firm initiates the transfer, the old firm verifies positions within 1 business day, and within 3 business days, the transfer must be completed. No new trades can take place during that window. At account opening, the client also chooses between a cash account and a margin account. Cash accounts require full payment. Margin accounts allow borrowing against the security's value, subject to Regulation T's 50% initial requirement. Margin accounts require signing a credit agreement, a hypothecation agreement, and possibly a loan consent form. Margin increases both opportunity and risk. Firms keep account records for 6 years after the account closes, and temporary items like trade tickets for 3 years. In the end, all these forms, signatures, and permissions exist for one reason: to ensure that every recommendation fits the real person behind the account. The Series 7 doesn't just test whether you can memorize that joint tenants have survivorship rights. It tests whether you understand why those distinctions matter. Because behind every account number is someone trusting the system to work in their interest. Know your customer, know the forms, and know the timeframes. When you do, you're not just passing an exam, you're speaking the language of trust that the financial industry runs on.